Welcome to the daily update, where I'll go over the action in the market for Wednesday, May 29th, and then we'll see how things look for Thursday, May 30th. And if you're a Houston Astros fan, I really feel sorry for you. That's a pure lie. The Mariners came back in the bottom of the 10th and actually won the game. Yes, I'm a big Seattle Mariners fan, a frustrated fan for many decades. Right now, we're kind of frustrated with what's going on in the market. We are really developing more negative charts, and we're losing that positive edge that we have been having. And instead of just looking like a pullback, we're actually seeing some weakness coming in. Now, we're still positive for right now. We can still get that back. We have GDP, the second estimate coming out on Thursday, which has an inflation component. Friday is going to be the big report with core PCE. If those come in friendly, that could really help the market. If they're unfriendly, that could really hurt the market. We're kind of in a in-between state right now. Just personally, I have both short positions and long positions on the S&P currently, and have for the last few days, as this weakness was developing, setting up some short positions and then going with the positive backdrop with some long positions. And they're still kind of in the balance right now. What's really kind of cool is when I have positions where they both end up profiting. And yes, in my program, that can happen. Before I get started, I am going to go into the program. I know that everybody that watches this video is not necessarily interested. I'm actually going to put a chapter jump ahead if you don't want to hear a little bit more about the program. This is launching next week. And so this is my way to promote what I'm doing in a shameless way. But if you're just not interested, look at the video, at least on YouTube, where I can put a chapter in there and just skip beyond this. I only want people in the program that really want to be in the program. Plus, it's kind of a picky program. Not necessarily everybody who wants to be in the program will necessarily be in the program. But for the month of June, this is what I'm going with for right now. It's going to be free. Yeah, you'll have to sign up, but it's not going to cost you anything because I'm rolling things out. There's well over 100 hours of videos of courses that I have that I've been working on. And it's at least for June, possibly into July, depending on how things go. And once you have a chance to check this out, if you want to remain a member, then it will become $97 a month. There is what I call the affiliate program, where you're automatically an affiliate just by being in the program. If you don't like the $97 per month, if you get one person to join the program for every month that they're included in the program, half of your $97 is paid for. If you get two people, now you're in the program for free. So it's a way, since I'm not very good at marketing, it's just a way for me to reward folks that maybe have friends or somebody. But make sure you find good quality people, because if they don't last in the program, they're gone. They have to stay in good standing for your part of the membership fee to be taken care of. And you can go beyond that if you want to try to generate some income. Maybe you're really into marketing. What are some of the things that are included? The daily videos, you'll have first access. What you're watching right now is free, but next week it's going to be, you're going to have to be a member, even though that's free as well. It's not going to go public until the market actually closes for that day. I do have online courses. I'm updating the basic course. Some of you took that class. It's about 3 years old now. I've been updating the charts. Some of those things never change in that course because they're foundations that are always true, but some of the charts are outdated when I get into other parts of that particular course. And that's what I'll be rolling out first. And then I have a very lengthy, very involved technical analysis course. Everything that I talk about in these videos, I'll be breaking down and explaining in detail with examples, all the different charts, why I use the approach that I use, things to look for, things that can catch you off guard, and it's really pretty lengthy. I also have a strategies course that we'll be rolling out, where you can take advantage when the market goes up, you can take advantage when the market goes down, you can take advantage when the market goes sideways. And like I said, I have a couple of different strategies, long and short at the same time. I haven't gone sideways yet because with this low volatility, that kind of puts you at risk. but there will be different strategies. Some of these are going to be very conservative and more long-term. Others, you're going to have to really pay attention and just see which ones end up fitting for you. And then the last one is probably the most important one, is the mental analysis. Now, you can learn the basics, you can learn technical analysis, you can learn strategies, but if you can't get your emotions under control, none of that will help you, because we have to deal with fear and greed. You've got a lot of money on the line and things go crazy. You would have been better off going to Las Vegas. We want to try to get out of the gambling mode and into the high probability mode, where we have a plan, we execute that plan. It's very unemotional, and we don't really let our emotions control what's going on with us. And I do online courses that are live. The pre-recorded courses that you just saw here, and they're usually broken down into about 20-minute chunks because they're so long. I want to make it so you're not, killing yourself. But I may, at times, usually based on feedback, take different bits and pieces from all of these courses and put together a shorter version of a course that will usually be live, and it'll be online. And you as a member will be able to okay, let me try that again. You as a member will be able to attend that course, and you have to be a member to do that. These are not public courses. And then there'll be a recording of that course that you can go back and watch as well. And I will do live in-person courses on an as-needed basis, but that's more as the demand dictates. And there is going to be a community chat room. One of the things that's been very frustrating on YouTube anyway is if you post a comment, I see that right away, and I check those very, very regularly. And then I try to respond in a very timely manner when I'm able to. Well, if you reply to my response, I don't get notified of that until there's an email, and there can be a real lag from the time that you said something until I go, oh, somebody wrote back. I don't see it otherwise. Well, I want to try to overcome that by having a community chat room where I keep this open. If I'm going to be away, I'll say, BRB, I'm going to be away for a while, but the room will always be open, and you can come in and ask questions. You can just make comments about what's happening in the market. I don't know if it's going to be moderated right now. If you guys all behave yourselves, yeah, it'll be just fine. We need to stay on topic with this. Now you can, how you doing? What about those Mariners? Things like that. That's okay. But we don't want to go off on some crazy tangent. That's why I don't really belong to any chat rooms now. You get these irrelevant comments that somebody grabs a little part of and then just runs with, and the room is basically changed into something else, and it's way off what you were trying to get to in the first place. But we're just talking about the market in there, not opinions, not things like that. Just a chance to maybe get an update as the day goes on. And then you'll have a chance to do online posting. You can post a question, you can post a chart, what have you. Okay, there'll also be question and answers. That's what we're going on now. If we see the market really drop, what's going on? We check it out. Oh, this looks like is what's happening. Or if the market really shoots up, there might be something going on. And I really want to try to keep this limited. Don't go on with your dissertation of things. If you want to do that, talk to me and I'll show you how to set up your own blog. But if you want to keep it confined to what we're doing and relevant to the program. Now, some of you, yes, you're going to make comments about individual stocks, which I don't do. And so my input for that is going to be very limited. And I just do the S&P 500. Yeah, I look at some of the other indexes, but I don't actively participate in those. And so you're going to try to get the conversation a little bit out of the S&P, where I'm probably not going to be able to go with you in that area. So still bring it up. Maybe someone else will have something to offer there. And I want to keep it vibrant. I want it to be a good, safe place for people to come to without worrying about asking a question and someone calling them stupid, because you're going to get booted out really quick if you're rude or disgusting or impolite in the room. There's going to be very little opportunity for second chances in that because it happens everywhere else. I want this one to be a healthy and productive room. And then there will be videos that I do that are not public. There'll be debriefs, maybe during the day. I might do something. And then what I'll often do is maybe once a week, we'll go back and do the weekend review. We'll look at different things that we may have talked about in the chat room. And this kind of ties into something later, but I'll also do them on an as needed basis as well. And then live sessions where I'm calling like a vlog, where typically I will post something right before the market opens. That's not a public video because from the time that I do the video, like right now, it's many hours until the market opens and things can change, things can modify. And so I used to write a blog post. Now I'm looking at doing a video blog, and I've been practicing those over the last few days. And there may be posts during the day. If it's a sleepy day, that you may not get much more. If it's a really active day, I may have a number of different posts, and you have to be a member to access that. And then if we're looking at possibly entering some kind of a position, whether long or short, I will likely go live anywhere from 30 to 15 minutes before the market closes. My philosophy is never get in at the open, watch the day unfold, and then make your decision as close to the close as possible. And so I will go live. And if nobody else shows up, it'll still be recorded for you to be able to watch later. And then there'll be supplemental videos. There are topics that I'm doing a lot of research on, like ESG, what's going on economically, the debate, whether we're going to go into a recession or not. All of those things are available to members once I post those videos. I've done a couple of supplemental videos in the past, but there's a whole list of other ones that I want to do that kind of go beyond this whole program, but still could be very helpful and very educational. And then this is probably the one that a lot of folks are going to really hone in on. And it's unfortunate because this is the culture that has been created where people want to be told what to do when it comes to the stock market. Yes, every day I have what I call a sample portfolio plan and ideas. Based on what I teach in the program, if we're looking either positive or negative, we have some ideas. These are possible positions that you may consider. Totally at your own risk. You make all of the decisions. And when I start doing these videos, you're going to look at some of these and you're not going to have any clue what's going on. So don't do any kind of strategy until you understand it, you've practiced it, and you have a really good grasp of how it's doing. I also have a daily journal, a whole sheet that is in e-format. It's a PDF. And I've not put a lot of graphics in there in case you want to print this out. I don't want to wipe out your toner cartridges. And it has an action sheet right there. This is the plan that we develop before the market opens, while the market is closed. And then I never deviate from that plan. So if we're looking positive and the market tanks 5%, somebody says, whoa, you're going to go short, John? No, I made my plan up before the market even opened. And then after that day closes, then we'll fall back and regroup and look at things. And I will be doing this more in video format, and then you'll have PDFs available, not only of what I filled out as an example, but there'll be blank sheets that you can use to come up with your own plan. Because my hope is that you're not just blindly following what's going on here, that you're actually coming up with things that you feel comfortable doing yourself. Here is an email address. And at some point, if you want to get into the program, even if it's free, that's going to require an email address from you as well. I'm setting everything up on Substack. I can do the videos, I can do the chat room, I can do everything on Substack. And because I hate WordPress, and kind of surprising, over the Memorial weekend, I was working on things. Something took me 20 minutes that used to take 3 months on WordPress. And I'm like, is that it? This is working. There's no bugs. I don't have to spend hours troubleshooting. Anyway, okay, so I am done with this. Now let's go back and talk about what happened. Right here is where I will put in the chapter, so you can skip ahead if you want to. Okay, right at the open, we had a gap lower open. The futures were negative and we're drifting more negative as we were getting into the open, and we're negative right now. The last I checked right before I started recording, we were down about 0.5%. We dropped right down to S2 at 52.66. And then we tried to rebound, but then we hit resistance. We didn't get back up to our S1. We got up to 52.80, a nice round number. As the day went on, we chopped pretty much sideways, and we failed 3 times to get above that 52.80 level. And then we closed at the low, pretty much about where we opened. So we were down 0.74%. We're still below average with volume. Not, we have up days, we're below average. We have down days, we're below average. It's just, we're really trailing off, and there's not an awful lot of conviction currently. We are positive with our technicals, but we are seeing some weakness really starting to develop. There are some negative things as I go through the charts that I will point out. What was pressuring stocks in Wednesday's session were interest rates going up. And that's a real enemy right now, usually all the time, for stocks, because I guess Kashkari came out on CNBC and said, well, we're just going to keep rates there for a long time until we see lots of evidence that inflation, and I'm sure he sounds exactly like, is it a he or a she? I don't even know. I don't watch CNBC anymore, but that didn't really help the markets all that much. And then these reports coming out are going to also have an influence on things, keeping an eye on geopolitical things just in case they impact the market. So we did see a broad-based decline in the indexes. Of course, if you're from UK and say it the right way, you would say indices closed at the lows for the session. Interest rates are what were really pressuring stocks on Wednesday. We still have our stochastics, and that's wearing off, but we have part of it, the longer term one, that is still extreme positive. The slope oscillator is extreme positive, but now it's dropping more below its moving average. So it's kind of like positive and negative at the same time. We still have the TTM squeeze, just barely extreme positive, but it is declining, as with the Sean trend meter, still positive, extreme positive, but it has been declining. We already have some oversold indications. We have the McClellan oscillator for the S&P, and we have one area of the PMO studies that are already extreme negative. And the scenario to this point really hasn't changed, higher for longer, with more of a stress now on the longer times, according to what Kashkari said on Wednesday, because inflation hasn't been coming down, and they want to see a lot of proof that inflation is actually declining before they come in and cut rates. They're still looking at possibly September as the first rate cut. Now that's going to change. And this idea of decreasing quantitative tapering, that's pretty much gone now. In fact, I'm going to remove that from the scenario if I remember to do that. The dollar was up and interest rates were up. We're at 4.62%, where we had been at 4.54%. This climb in interest rates is really causing a concern. We're inverted with the yield curves. Sentiment is still neutral. We ticked down with the down day. We had been at 53. Now we're at 47. And we are positive with our trend, but that green line is really coming down, and we're dropping below the moving average. We're still barely above 20. With the down day, our bias is negative, and I've switched our momentum from being mixed to negative now because there's a lot of weakness that's been building up. I started to see this at the end of last week, and now it's carrying over, and we're starting to see that continue for right now. But we're still positive. We're still above moving averages. We're still longer term looking okay. But the market's going to have to come in here and really do some buying to change this back to a more positive environment. We did get the MBA mortgage applications index. It was down 5.7%, with refinance applications down 14%. I mean, in a rising interest rate environment, would you look at refinancing? And purchase applications were down 1%. Here's a chart of this. We just keep track of this on a weekly basis, where we see the decline in the most recent reading after we had seen 3 weeks of positive applications. And then looking here, I'm not going to go through this in real detail. This is the 10-year yield, a daily chart with different studies plotted on here. I mainly just track the overall trend. I'm not looking at all these head and shoulders whatevers and projection areas and so forth. I just kind of, what is the trend of interest rates? Are they up or down? I don't do a lot of intense studies as far as the 10-year yield. You may want to stop this and look at this for a moment here. And then aside from tech, absolute equity valuations do not look particularly elevated. So the current reading up here is we're at 18.5, and the median is around 16. That's when we look at the US. And then this is the rest of the world broken out a little more individually. Then market pricing, a rate cut profile sits close to our view. Okay, yeah, all right. So we have the blue line, which is the Fed funds rate. And then this is what the futures are predicting are going to happen. And this is heading down more into September now. And this is what the Fed is thinking will happen. And here's Deutsche Bank projections of what they think are going to happen. And I show this chart probably at least once a week, and it's always updated. This is exposure to equities. A lot of folks are really long the market. In fact, up over 70% now. And then looking at the forward PE ratio. Now, according to this, we're just a little bit under 20. That may have been, no, it's as of May 23rd. We're actually in the weekly video where I look at the forward PE ratio, we're just a little bit over 20, but we're right at that expensive level, even looking forward. And then this is mega cap growth and tech positioning, where a lot of folks were getting out of it, is where we're going down in April. Now they're starting to get back in. The negative side is we're not seeing a lot of inflows. The positive side is if we do turn back more positive, there's more room to run with this before we get to an extreme positive reading. And then here, I show this every once in a while too. This is looking at Morgan Stanley, and I'm starting off in the middle area with the base case. That's where they think we're at right about now. The earnings are $283 for the S&P. That would give us a PE ratio of 19, and that would put us at 5,400, which is we'd have to go up 1.8% to get there. If earnings go up in the real bullish case to 298, that would put us at 21.3 for the PE ratio, which would put us at 6,350, which we would need to see almost a 20% increase from there. If we drop with the earnings to 228, we're going to need to drop about 20% from where we're at right now. I don't put much weight in this. We just kind of look at it and go, okay, that's interesting. I'll keep that in the back of my mind. Here's just one chart that I found on Twitter. We're keeping an eye on the smaller banks. And I've showed this chart before, and this is more updated. These are unrealized gains or losses, meaning that they're still on the books, but they haven't actually closed out these positions yet or sold them. And a lot of these are with the smaller banks. And they're showing a lot of losses right now. And a lot of the strategies that these banks were coming up with depended on the Fed cutting rates in 2024. And if that really doesn't happen, that's going to cause some problems. And so we're just keeping that in the back of our mind. We had a Silicon Valley Bank a year ago. We had Republic Bank a few months ago, was New York Community Bank. Is there going to be some kind of a wave that comes through if interest rates don't start being lowering and being cut by the Fed? Here's our intraday chart where we set pretty much the low right at the open. We gapped lower down to S2. We tried to bounce up once, twice, three times a lady, and we're not able to do that, and then just fell back down pretty much to the low for the session. Here's our intraday chart. Nothing really all that insightful. We were drifting down a little bit before the market opened, and then we really gapped lower and then saw the selling, and we're down about 0.5%, as I said, as I went to record this. This is a positive thing and something we can hang on to. We're still seeing the blue line, which is growth, above the red line, which is declining. Value over the last couple of days has just been getting hit hard, where growth hasn't necessarily been doing great, but it's outperforming when you compare the two with each other. This is also looking okay, the growth to value ratio for the S&P. Actually, even though both were down, growth was down less. So we were down with growth, but down a lot more with value with the large caps, down a little bit less with the mid caps, and down less with the small caps. And we mainly focus on the large cap area. So the small caps kind of declined a little bit, not showing an awful lot of strength with the growth to value ratio, just barely moving with mid cap growth to value, and showing a little bit more improvement with S&P growth to value, but not necessarily breaking out and looking all positive at the present time. This is looking better, though. These are the ETFs that we use to measure growth versus value. This continues to go up. It was up after Tuesday, and it was up again after Wednesday. And discretionary to staples. And it's not that discretionary did all that well. It's that staples have been really declining. So we're seeing a bit of an improvement between the two when we look at this ratio. Large cap growth, yeah, it was down 0.5%, but still coming off of recent all-time highs. The Wilshire also coming off of recent all-time highs, but was down. Our trend, we're below the moving average, and we're just barely above 20 right now. The green line's on top, so we still default to positive, but it's declining, and the red line is going up. If we see another down day, 1 or 2 days to finish out this week, we might see the red line actually cross above the green line. Of course, if we see some up days, the green line could turn and go back up. But the market is just having a difficult time defining a trend right now. Here's the short-term version of that. Below the moving average, green line is declining. And we're picking up a little bit with volume, but we're still low overall. But looking at sentiment, we're picking up just a little bit here with the Ulcer Index. We did get the latest reading from Investors Intelligence. They came in at 3.45, above the 3 level, but could still go higher from where we are right now. And we're seeing a real advance in the VIX, both with the line chart, that's the closing value, and the bar chart. We're coming back up into the moving averages. The VIX had become very low, showing a lot of complacency. I think folks may have been really taking this week right now for granted, and because we have positive seasonality, and just thought, oh, well, we're just going to go up. Well, that's not what's happened, at least to this point, but it can change. We're also seeing the VIX of the VIX continue to go up as we've been going down with the S&P. Now, this is also changing. We're seeing the momentum of the VIX going from being a downward momentum to crossing back over and seeing where the momentum is switching back over to positive, which would be more negative for stocks if it stays that way, because that means the VIX will be increasing. The SKU index, we're still in this red area. We saw a kind of a big move on Wednesday. We're wondering, is that big move over? It could still be positive, but we're still looking at a high reading here where the market is expecting a pretty big move. We don't know if that's going to be more to the downside or if it's going to turn and go to the upside. The equity put call ratio actually declined here, which is kind of strange, but we're still going up with our 5-day chart. That's negative for the market. We're not really seeing a lot of pickup in volatility risk premium right now. We're still at the lower band. If we were really getting set to go up, and this is kind of mirroring the VIX, we would get up into this area right now, but it is increasing as we've been under pressure. We did see a tick up with this fear gauge, and we also ticked up with the other fear gauge that we follow. We're showing some weakness here with our advanced decline line. We are coming down, which is not positive, and we're seeing some pretty hefty red bars right now, but we're still above these longer-term moving averages based on price and volume. We're also seeing a little bit more weakness with the new highs, new lows. We're contracting with the new highs, seeing a bit of an expansion with the new lows. That's keeping our 5-period and our 10-period declining. We're dropping below zero with both the 19 and the 39-day exponential moving average when we look at the advanced decline ratio. But this is kind of positive for now. Accumulation distribution, yeah, it declined, but it's still above the moving average. If we drop below that, that's going to turn things even more negative. If we can stay above it, we have a chance of remaining positive. And this is kind of interesting. The chicken money flow was actually up on a down day, and the moving average is barely starting to turn up. This is also another smart money indicator, which is looking a little better. The chicken oscillator is declining, but still above zero. We saw more of a decline with the cumulative NYSE advanced decline line. We're also coming down to the moving average with our regular NYSE advanced decline line. Also seeing some weakness with this other NYSE advanced decline line. And when we look at common stock based on price, we're declining. We're also declining based on volume. Now, there's something positive in this chart. You notice how we're going down a lot faster based on price and not quite as fast based on volume. That could actually be a positive divergence. And I haven't shown this in a while. I've been only showing it in the weekly videos. When we take the NYSE new highs minus the new lows, we've been positive for quite a while. Well, we just dropped negative. Now, the moving average is still positive. That's the 101 here, the red line. But since we dropped negative for the first time in a while on the daily score, I just wanted to bring that to your attention. That's showing more broad market negativity. And then the S&P cumulative, based on price, is declining, and based on volume, we're not really seeing much of a divergence there. And we're showing some weakness with our advanced decline line studies, coming down to the moving average with the NYSE common stock, the S&P dropping just barely below with the mid caps and looking a little bit more below the moving average with the small caps. So here's our daily chart. We're not really getting an awful lot from this right now. If we continue to fall, we have a pivot point and the 50-day moving average below current price. If we fall, we might be at about that same point, meaning the pivot point and the moving average might end up at about the same place at the same time. We did pick up with volume on the bottom, but you can see even the moving average is dropping off. We're no longer extreme with our short-term stochastic, but we're still above the midpoint. We're declining with the intermediate-term stochastic. We're still extreme positive, but crossing below the moving average with our longer-term stochastic. We've dropped below both of these lines with the 20-period double and triple exponential moving average steady. We wanted to get back above this. For right now, the fact that we are remaining down below it is more negative in the short term. We're declining with the 20, 50, and 200 period moving average study just on the S&P 500. We've dropped negative with the force index. We're still above the 20 period moving averages when we just look at the simple and exponential moving averages. If we keep falling, will these provide support? And we're into the +1 channel with our standard deviations chart. That's the negative side, that we're coming down. The positive side is that we're still above the midpoint. Balance of power is declining, but still above zero. We're still looking more negative with the go, no go with the lighter blue bars. We're still just a little bit above the midpoint, looking at their highest high value. We're still just barely extreme negative. I have this line at, I think it's 150, and we're at 151. But this has been coming down and turning to the darker shade of blue as we've been seeing a bit of a pullback now. And we're right inside both of these lines with our 50-period double and triple exponential moving averages. We were encouraged, at least I was, we were hanging out above the double. Now we're coming down to the triple. If we break that support, that could be more negative, or we'll see if we can bounce up off of that. And we're keeping an eye on the 50-period moving averages, just in case we break below the 20s. We are declining, but still positive with the ease of movement. The Erin is positive, but has been declining. We're getting extreme negative already with the S&P McClellan oscillator. Now, this has more room to go down, but when we drop below this blue line, that's when we start to get extreme. So we're declining with the summation index based on price and volume. So that's negative, more intermediate to even somewhat long-term. We're not extreme with the NYSE McClellan oscillator, but we are negative with this right now. So our summation index for the NYSE based on price and volume are declining. Swenlin trading oscillator, which has been negative all along, continues to be even more negative and is not necessarily extreme negative now. We're rolling over with the PMO when we look at it by itself, but we're crossing below the moving average based on price and volume. We're already extreme negative with the PMOs that are rising, but this could still continue to go down. The buy signals are also declining, and we're rolling over and going lower with the PMOs that are above zero. We are negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We've dropped below the moving average, but we're still extreme positive with the slope oscillator. We're just about down to the moving average with the MACD. So we're turning more negative in the short term with the slope below its moving average. The TSI is rolling over, hasn't quite crossed below its moving average, coming down to the moving averages in the intermediate term with the MACD, PMO, and PPO, showing a little bit of a rollover here with our longer term KST and TRIX oscillators. We're still above all these moving averages, and that's encouraging for the time being. But we're declining with the bullish percent index. Since we're declining, that's negative. However, we're still above 50, so it remains positive as well. We're also declining with the NYSE bullish percent index, and we're declining with the NASDAQ 100 bullish percent index. The money flow is above 50 and still declining. The ultimate oscillator has now turned negative. We've dropped below the midpoint. The vortex, green line is still on top. That's positive, but it's declining, which is negative. We're still looking okay as far as the RSI. We are declining with the 14 and 9, but we're still above 50 for right now. On balance volume, we had a down day, but we're still above an advancing moving average. We're getting kind of negative here with the stocks inside the S&P above their 20-period moving averages, but we're not extreme yet. So we're keeping an eye on this study. And we came down to some kind of low readings before we finally saw some kind of a bounce here when we compare it to what happened back in March of 2023. So not all hope is lost here, but it's certainly not giving us a very confident feeling right now if we're positive. We're dropping further below the midpoint with our 50-day simple moving average study. We're dropping below 100, we're dropping below 50 with our 100 period moving average study. We're declining, but still well above 50 with our 200 period moving average study. The copy curve has now switched over to negative. The Sean trend meter is declining, but we're still up in this kind of greeny area. And we're seeing a mixed picture here. The Heiken Ashi looking more negative, where the Kegi is still positive, but pointing down. So it has a real negative slant to it. The Renko, it's like, what? We're going down. I'm not seeing anything. But in the 3-line break, it's like, hey, party on. Long term, we're dropping below the red line with our 150 and now our 200 period moving average study. And for most of 2024, we've been above this red line. So this is showing slight weakness in the longer term. We're wondering if we're coming up to the 50 days. Right now, it's supposed to be around June 4th to see if that even means anything. We don't have a confirmation signal yet with the Hindenburg-Ullman. We did get one signal that was generated. We have to have another spike within 20 trading days, which will be pretty much near the end of June is the window for that to happen. We're looking negative with the mid caps and the small caps in the short term. We're barely hanging on positive with the S&P. And we're negative across the board when we look at bonds based on price, and the dollar, which had been showing some weakness, it was up, but it's still in a short-term downtrend. And decision point hasn't changed anything yet, and it's looking positive across the board. Saw an awful lot of red here. We saw Canada had a little bit of trouble, and we're seeing the financials in healthcare, which the healthcare, that's more defensive. So that could actually be positive for the market. The dollar was able to get back above 105 and had a bullish MACD crossover, which could be negative for stocks. All of the sectors ended up being down, but this is kind of encouraging. Communication, tech, and discretionary were down, but down less than the rest of the sectors that we saw. We're still seeing a longer-term negative divergence when we have this new take on Dow theory. We never did set an all-time high with the S&P equal weight or the QQQ equal weight. And the equal weight is really underperforming. So we're seeing this ratio really going up, meaning that, yeah, the mega caps, they were up on the day, but then gave a lot of that up as we got closer to the close. But on a relative basis, they're outperforming. So that's why we're seeing this ratio going up. The Dow is right down to this pivot point, still below its 50-day moving average, and just has not been doing very well lately after setting that recent all-time high. The diamonds continue to be negative, and for the Elder's Impulse system, we came right up to this pivot point, and now we're having a really difficult time with the NASDAQ. So these pivot points seem to matter when it applies to the NASDAQ. NASDAQ 100 didn't quite get up to this pivot point, but has also been under recent pressure. The Qs remain neutral, though, for the Elder's Impulse system. The momentum is still positive for the NASDAQ 100, but starting to roll over just a little bit. The Qs are still looking okay when we compare them to the moving averages. We're still above both lines, and that's still positive. The small caps, of course, they had to be down. They have to go drop below the pivot point and below their 50-day moving average. And yes, I'm cynical, not because I have any personal take on this. I know some of you that watch these videos, you are interested in small caps, and this has been a very frustrating time for you. We are still negative with the Elder's Impulse system for the small caps. We're dropping below the 50-day moving average with the Russell 2000 small caps, dropping below 50 with the RSI, rolling over and turning negative with the momentum. The mid caps dropped below their 50-day moving average. This had been an area of hope after Tuesday. We dropped below that. Now we have this pivot point, and it was this pivot point where we bounced up in April. I'm not saying that will happen this time. We just want to be watching for that. So keep an eye on the mid caps, see if they come down to this level, which is just above 2,900 for the mid cap index, and then see if we get some bounce up from there. If we don't, that could signal more weakness, possibly. The mid caps continue to be negative with the Elder's Impulse system. Apple was up barely, it had been up more during the day. It's still above the moving averages. The longer we can stay above this, the more we might see a golden cross. Tesla is still in a downtrend and still coming down to its 50-day moving average. NVIDIA just continues the Frank Sinatra fly me to the moon. And Microsoft was down a little over 0.25%, but coming off of recent all-time highs. Meta was down over 1% and having a difficult time getting back above its 50-day moving average. And Amazon was down slightly and seems to be hanging out around its 50-day moving average. Google was down a little over 0.25%, but still hanging in there for now. And Netflix closed well off of its highs, ended up being up, has not set a recent all-time high. The FANG index coming off of a recent all-time high, but was down. The financial sector starting to drop a bit below its 50-day moving average. And we're still seeing this ratio going down. And it's not that tech is doing great. It's that staples are under pressure right now. And that could be positive for the market. As long as this keeps going down, that means that we're more positive on tech. Tech is growth, and that could give the market some support. The dollar was up, and it's also still in an uptrend. It got back up into the 105 range. Looking internationally, comparing the S&P to the world index, we're seeing the shorter term relationship drop off, but the longer term correlation based on 50 periods, that's still hanging in there. But please keep in mind, there's a day lag between the red chart, which is the S&P, and the black line, which is the world index. Staple sector coming down to its 50-day moving average. Are we going to get a bounce from that? Or are we going to see more weakness? That could be positive for the market. Utilities also coming down over 1%. Still has a ways to go to get back to its 50-day moving average. Healthcare was also down, but this is interesting. It opened, went down, and actually closed almost at its high. Energy has also been seeing some weakness now. Total stock ETF coming off of recent all-time highs, but it was down over 0.75%. We are going up with the 10-year yield. That's been the big enemy for stocks now because we're going down with the 10-year based on price. And looking at our growth to value ratios, we're seeing some improvement here with Qs to the S&P. Not seeing much improvement at all with discretionary to S&P. Large cap growth is looking pretty good when comparing to large cap value. So the large caps are showing an improvement, not much with the mid caps, and came back down slightly, but still above the moving average with the small caps. We're no longer extreme positive. This is more longer term negative now. When we were staying up in this extreme positive reading, that was suggesting good momentum. With the 10-day average of the S&P 500 highs minus the lows, we've now dropped below. We're also looking more negative here with our advanced decline ratio. We dropped below the midpoint based on price and volume. And this could be positive, but we need to see more follow through. The S&P to utilities ratio had been coming down. That was negative. If this could start to go back up, that could actually give support to the S&P. And we're also seeing this ratio declining when we look at staples to the S&P. We want to see this continue to decline if we're going to turn back more positive. So what's our outlook for Thursday? We're positive for right now, but we're losing that positive edge. And this weakness that we started to see at the end of last week is growing right now. But at the same time, we are in a positive seasonal time. We're going to get, did I forget to do this again? Okay. We'll go to the next slide here. We want to keep an eye on the different geopolitical events. I really thought I changed this. So this is probably, Thursday and Friday are going to be kind of influential as far as economic reports. We're going to get the jobless claims, and I don't really pay attention to this. International trade in goods, retail, wholesale is not a real market mover. GDP, the second estimate. Now, if the number comes in about like what we had last time, it's probably not going to be that big of a deal. If it comes in hot or cold compared to what we saw last time, that could either rattle the markets or enthuse the markets. The big inflation report is going to be in Friday's session. Here's what we're showing for the upcoming calendar for Thursday and Friday. Seasonally, we are positive. Yes. Across the board positive. Not that that seems to have mattered to this point, but historically, this has been a positive time. We also see positive seasonality, not only for this day, but going into the end of May. We just have 2 trading days left. And here's Thursday, where it's a little more positive. When we look at what happened in 2023, we also could be coming into some longer term positive seasonality. We should be seeing some positive seasonality going into the end of May, which really hasn't happened yet. May tends to be strong, but like I said, they put this chart out a week ago where we still had a week left. I mean, we're not up 5% now. I think we're still up 4% or something for the month of May. Haven't officially looked at that though. And then looking out into June, where we do see some positive seasonality at the first part of the month, and then Juneteenth, still not quite sure what that is, but Anyway, that'll be happening. I think the market's closed that day. So we just want to keep an eye on going forward, what we're looking like. And then the election year, going back to 1950, a good track record, up 15 out of 18 times, down 3 out of 18 times, with a return of 1.3%. Tom Bowley still has us in this positive time as we start to close out the month of May. So the warning signs, the advanced decline lines are weakening and they're barely above their moving averages for the S&P. They're starting to drop below with the mid caps and the small caps. We did set recent all-time highs with staples and utilities being strong. And that, sorry, the cat just decided to become famous. And that was a warning sign because we don't, at least on a short-term basis, when we see staples and utilities doing really well, that's a warning sign to us. We're keeping an eye on energy as well as healthcare. Energy, if it's turning more defensive, because that could be due to geopolitical things, and then healthcare because it is more defensive. Growth to value, the S&P is improving. It's looking a little better as of Wednesday's close. And the discretionary to staples ratio, not really doing all that well right now. The S&P is extreme negative with the McClellan oscillator, where we're just flat out negative with the NYSE McClellan oscillator. The Swenlin trading oscillator is negative, the parabolic SAR. The slope oscillator is below its moving average, but it's still extreme positive. The ultimate oscillator, that's a new addition to the list, the Copic curve. And stocks are below their 20, 50, and 100 period moving averages inside of the S&P. The equity put-call ratio continues to go up based on 5 periods, and the summation indexes for the S&P and NYSE are still declining. Positive signs. We do have a shortening list here. Our oscillators are still looking okay, but they're starting to show some weakness as well as they're rolling over and could be getting ready to drop below their moving averages if we see more follow-through weakness. We're still above 50 with the bullish percent index, even though that has been declining. The Chaikin money flow is still positive. The Chaikin oscillator actually kind of delightfully positive on a down day to see that actually go up. The money flow is still positive. The vortex, even though it's declining. The momentum for the NASDAQ 100 and the bullish percent index, they're showing weakness, but they continue to be positive. And the financial sector is still positive. So we are positive, but we're losing that positive edge as weakness continues to develop. That's the negative side. On the positive side, we do have seasonality. Then in the short term, I'm saying that same thing because that's where everything is being played out right now, is in the short term. We're positive, but weakness continues to develop in the intermediate term. And we have some of our primary indicators like the parabolic SAR and the summation indexes. Those are going down, and that's not positive, but we're still kind of looking more positive for the time being. We are still positive in the long term. We're no longer extreme positive, but as long as we're above the 200 period simple moving average, we are still positive that way. Thank you. I really hope you found this helpful. Please have a very, very good day. Go Mariners. We're going for the sweep against the Astros. Have a great day, and I will talk to you in the next video.